it's 11 o'clock now, so I think we can begin. Hey, Candice? Well, good morning.
Perfect.
Yep, good morning, everybody. Thank you for coming to join us at our talk this morning on tax law changes in Eswatini. That's the former Swaziland, for those who don't follow current affairs. So I shall try to make sure I use the proper name, Eswatini, right through. You've got two of us speaking this morning from Regan van Rooy. That's myself, Russell Eastor, and my colleague, Sihle Mapalisa.
Good morning.
And Sihle will introduce herself later to give a bit of background. She's one of our transfer pricing managers. Myself, Russell Eastor, my pedigree, if you like, having joined Regan van Rooy in the course of last year. Spent a long time in different parts of Africa with Deloitte in South Africa, PwC in Uganda and Nigeria, and then subsequently with a commercial company, with a lot of its operations in Nigeria, but also Kenya and South Africa and some other more exotic places. So lots of experience over the years in different parts of Africa, and I've been to Eswatini a couple of times over the years as well. So back in the bad old days, before I joined the accountancy firms in South Africa, I was with HM Revenue and Customs in the UK, and I also spent some time advising the Nigerian government on tax policy as part of their fiscal policy reform committee under the last government. So a bit of a combination of sides of the fence I've sat on. So that's, if we can go on to the next slide, I think, please, Sihle. And yeah, that's what we're going to discuss. And the next one, please. These tax law changes came in this year with effect from 1st of July 2024. And what we're going to do today is concentrate on the more important ones affecting companies, at least the ones we judge to be more important. There are some changes affecting individuals. Now, back a bit, there are some changes affecting individuals, quite a few things on powers of the tax authority and how they can collect their debts. But that's perhaps something we'll leave for another time. Some rules of the House for this morning. I think if you've got questions to ask, stick them in the Q&A box or in the chat box, and then anything that looks really important, and we'll deal with immediately. Otherwise, we'll have a session at the end on questions and answers after we've finished. We're going to try and keep the 30 minutes time scale we stipulated, but we will keep it open after that in case there's a number of questions we haven't got around to dealing with. So I think that's the housekeeping rules, and then let's get into the meat of it. I think when we did a newsletter on this, we split the changes into the good, the bad, and the not very nice at all. And I'll probably make some references to that as we go. But here's one of the good ones. Corporate tax rate cut from 27.5% to 25%, with effect from the years ended 30th June 2023. So if your year started after that, you'll get the new rate. 25% generally looks a good thing, doesn't it? Everybody likes a tax cut, unless perhaps you've got big deferred tax assets, when the value of those will obviously reduce because of applying the new tax rate. But generally a good thing, and not to be complained at. And that's probably the main part of the good news. Right, have we got, what's these notifications coming up, Candice? Anything I need to do with?
No, nothing. You just carry on.
Right, I will then. The other interesting one is a development enterprises incentive. New business projects that get themselves classified as a development enterprise, they can get a 10% tax rate for 10 years. Perhaps looking a little bit of an out-of-date approach in some ways. Not great if you're an investor who's subject to Pillar 2, not great if your country where you're from taxes foreign dividend income, because essentially Eswatini is transferring its taxes to your home country. But yeah, for some people, it'll be a useful incentive, and probably a bit of bureaucracy to jump through to get it. So we're not going to spend a lot of time on that, but it is there, and it may be useful to somebody. If we go on to the next slide, please. Yeah, we get into the things that are not so great. Right, withholding tax increases. And I think Eswatini is a bit like most countries in the continent. It loves withholding taxes. So the rate on interest and dividends to non-residents has increased to 15%. A lot of investment, of course, comes out of South Africa, and they have the benefit of a double taxation treaty between the two countries. That puts limits on the rate on interest and on dividends paid to qualified shareholders, i.e. those who own a reasonably large portion of the company, and that limits it to 10%, so they won't be affected by the change in the law. I think there is some bureaucracy to jump through to get the rate, the treaty rate. I haven't worked out exactly what it is, but we can explore that later. Right, if we go to the next slide, please. Branch profits tax, that's increased to 15% as well. Now, branch profits tax, for those who don't know it, people think they can get around the tax on paying dividends to a non-resident by not having a company, by having a branch, PE. Government's ahead of them and says if you do that, we'll tax you on the branch profits in some way, normally using a formula. That rate's gone up to 15%. Again, the double taxation treaty with South Africa gives some protection against that and keeps it down to 10, as I recall. So that could affect somebody. I think an awful lot of people probably have branches. Now, go back a wee bit. I was going to mention one thing on branches. There was a change to the definition of permanent establishment, which is not on our slides. It's quite a lengthy change in the definition. One of the things is to change the threshold for producing a PE by performing consulting services in country. And the threshold time limit is 30 days, which is quite a short one. You normally look at 180 to 183 days or perhaps 90, but this is 30. Again, the DTA with South Africa gives some protection. If we go on to the next slide, please, Siegfried. Thank you. Right, initial allowances. There was something there. Certain assets qualified for an initial capital allowance of 50% of cost. That's been cut to 30%, which is not so great, I suppose. And it now also only applies to assets costing more than 5 million Malangeni, which in South African language is 5 million rand. So that's a couple of niggly little restrictions on this allowance, but perhaps not too awful. There is a provision in that section I see which allows you to disclaim it, and that may be useful for a reason we'll come to later. Profits or losses from long-term contracts, that's a reasonably technical thing saying you have to use percentage of completion basis. So yeah, probably not vital for most people, but interesting addition to the law. If we can go on, please. This one could affect some people quite badly. And if you're looking for a tax planning idea, lending money to your shareholders is probably not going to be a great move going forward. So it says if you lend money to a shareholder, that is taxed as the shareholder's income. And they've taken away any discretion about this. It's the Commissioner General doesn't have a discretion any longer. It will be taxed in the hands of the shareholder unless he repays it in that year. So not great if you lend the money on the last day of the year and he repays the next year, because that will be taxable anyway. And there doesn't seem to be any mechanism for reversing that. So it's not like the old British thing where you tax loans to directors at the advanced corporation tax rate and reversed it later when it repaid the loan. Here it seems to be a one-off. You pay the tax and that's it. It's treated as income. There doesn't seem to be any way of dealing with that. It also leads to disparity between the company and the individual. So the individual gets taxed, top rate 33%. The company doesn't get a deduction, not at 25%, not at any rate. So, as I said, the best answer to that one is probably don't do it. It's not a way of, it's an anti-avoidance measure, but it's quite a harsh and perhaps crude one. Right, now we get into the things that are not so nice of a more general application. Loss carry forward. And this is a contagion, if we want to use that word, or a habit that's spreading across the continent. South Africa has done it, but in a much more nuanced and perhaps business-friendly manner of limiting how much loss you can use. Eswatini's just said, no, losses carry forward only for 5 years. It talks in the legislation about 5 consecutive years of loss making, but broadly it looks to me like if you've had a loss for 5 years, you can't carry that forward after the 5 years. So that is an expiry date. There's a couple of exceptions for timber and orchard plantations who are allowed to carry forward the loss until the plantation has come into maturity or production. And that did raise a question in my mind as whether you could ring fence different bits of your plantation as separate. Don't have the answer. It's one of those things that may require some sample computations and head scratching and thinking about whether there's any benefits in doing it. And this loss carry forward is also the thing I alluded to earlier, where it may sometimes be useful to not claim the initial allowance, because the initial allowance gets added to your loss, and if you haven't got an immediate use for it, you may not want to have it. Whilst if you're claiming under the annual depreciation allowances, that'll last for longer. So that's the one on loss carry forward. I think that's quite a radical change. And then what have we got next? Manufacturing income ring fencing. Now, there's quite a few ring fencing provisions in the Eswatini income tax order, the 1975 order as amended, but they're mostly applying to individuals. But this one applies to companies. So if a company has manufacturing income, that is ring fenced, meaning, what does that mean? The loss can't be set against other income. And it produces some, as always, when you get these declarations in the law, it produces a problem with where's the boundary. So what exactly is manufacturing and what is not manufacturing? And taking a hypothetical example, if I grow a product as an agricultural, as a farm, and I then don't just sell what I cut out of the field, but I process it in some way, does that become manufacturing? Is there a way of arguing it's all really part of farming? And I think that probably a matter of the precise facts and the degree, but those are the sort of things that I think will come up over the next few years as people try to work out how to implement the law. And there's been lots of experience in South Africa and other places about what manufacturing is. And I think that's the sort of thing I can see coming. People are going to have to apply their minds to working out what this means and is it disadvantageous to them. Next slide, I think, please. Right, this is another major one, interest deduction limitations. So, and again, this is a habit that's spreading across the continent, and the one in Eswatini is fairly crude. So deductions for interest and similar expenses is now limited. Similar expenses, that includes exchange losses, forex losses, it includes loan raising fees and also other things. And the deduction is limited to 30% of your tax EBITDA, earnings before interest, tax, depreciation and amortization. There's a definition of that included in section 1 of the order. And it's not just related party interest, it's all interest. So it's quite wide-ranging, very sweeping. Obviously, banks are excluded from this because the job of a bank is to borrow and lend money. If you have an amount which you can't claim, you can carry forward that disallowed amount for 3 years, but when you want to claim it in that 3 years period, you're still subject to the overall limitation. So it will take some tracking, it'll take some computing, and it's generally going to cause some companies, I suspect, to have to change their capital structure. The other sweeping one, which is perhaps more sweeping in the future than it is now, for a reason I'll mention, is capital gains tax. So capital gains on disposal of business assets are now taxable from the 1st of July 2024. Now, there are some quirks to that. One is that there was a change to the section 14 of the order, which allows capital loss to be set off against other income. That's very nice of them. There's not been a change to section 7 of the order, which is what defines taxable income, and it still excludes capital receipts. So that looks a bit odd. I think that's something that the government of Eswatini can change quite quickly, and they probably will. And it's also something I wouldn't necessarily want to hang my hat on and say this definitely means capital gains aren't taxed, because there's lots of other indications in the revised order and this Income Tax Amendment Act that suggest they really are. So probably better to assume they are going to be taxed and work out how it will impact you. There are some special rules for all sorts of things, part disposals, non-arm's length transactions, for individuals who are coming into or going out of the country, so deemed acquisition at the time of arrival, deemed disposal on departure, all at market value, so that can be quite unwelcome, but very normal in any country that has a capital gains tax system. When I say a capital gains tax, of course there is no capital gains tax. The capital gain is worked out in accordance with the rules, and that gain is then brought into your taxable income. So it gets taxed at the 25% company income tax rate. Yeah, we go on to the next slide, I think, please. There's some reliefs, which is always nice to see. So involuntary disposals, if you reinvest in a year, some reorganization of resident company rules, asset per share exchange rules, which are all very welcome, all reasonably complicated, and yeah, the sort of thing you get to grips with when you have a case to. But at least they're there, so that's something to be grateful for. I have seen countries introduce these capital gains tax and not bother with the rules, and then you have real problems. Go on, I think, please. Oh, one thing that's good is there's no indirect disposal rule. So if I've got a company, say for example in Mauritius, which owns a company in Eswatini or shares in a company in Eswatini, I can sell the shares in Mauritius, and there's no provision in the Eswatini order to tax that gain made by the owner of the Mauritius company. some countries, quite a number of African countries, have decided they do want to attack that. The other thing is, when does this apply for? I said it applies for disposals after July 2024, 1st of July 2024, which is correct. But if you had an asset, if you owned an asset before that time, then you're deemed to have acquired it on the 1st of July 2024 at its value on the 1st of July 2024. So, which is why I said earlier that maybe this is not going to be a money spinner for the Eswatini government immediately, and perhaps why it won't be necessary just now to urgently change the law on in the definition in section 7 of what taxable income is, but at some stage it will have to be done. But people should be looking at the value of the asset as at that date, as of 1st of July 2024. Now, I don't own a valuation company, so I've got no interest in this, but I think it's probably a good planning to start getting your valuations done, or to think what they might be, so you can protect yourself from this in the future. The other thing is, what's your cost base? Broadly speaking, it's what you spent on the thing, unless it was at non-arm's length. Broadly, what you spent plus improvement costs. There's some case where you'd have to deduct your depreciation, tax depreciation, if you've made a loss, but that gets a bit technical. But broadly, it's cost of acquisition plus improvement costs. As I said, the important thing is revalued as of the 1st of July 2024. So I think that's probably enough words from me at this stage. I've used up the 15 minutes that I promised I would use. And Sihle, I think you've got a few minutes to go through your exciting transfer pricing changes.
Thank you, Russell. Exciting stuff indeed. One must always consider the elephant in the room, which is what I would call it, transfer pricing. So there has been some new transfer pricing rules inserted into the legislation. Just to briefly talk through what it is, but I'm sure everyone knows what it is. It's rules that are said that arm's length transactions with associated persons need to be at arm's length. They should be conducted as if the parties were not related. Just one thing I want to point out is that with the Eswatini TP rules, these apply to taxable persons in Eswatini that transact with persons based in a jurisdiction that would be deemed to be a beneficial tax regime. So that is at the commissioner's discretion. Just to also highlight that transfer pricing rules in Eswatini, they apply to both cross-border and domestic transactions. I think an interesting thing that Russell and I spoke through is the fact that in South Africa, the legislation only refers to cross-border transactions, so it only considers those transactions. But interesting enough, in Eswatini, the domestic transactions are also included, and TP rules also apply to these transactions. Another point that came out, key changes that came out, is the methods have been included in the transfer price in the income tax legislation. So the legislation states that you should make sure that your transactions are based on the following methods, which is the CUP resale price method, cost plus method, the transactional net margin method, and the transactional profit split methods. These methods are prescribed in the OECD guidelines, so they have been specifically included in the Eswatini legislation. One thing that also came out in the changes is that when you are determining the selling price to compute the taxable income, with respect to certain export or import of certain commodities, your grains, oil seeds, and other products from the land, and hydrocarbons, which includes any derivatives thereof, you should use the selling prices that are quoted on the commodity exchange markets, price reports from statistics agencies or government price setting agencies. So it's not just a matter of using the methods that are stipulated above. You also have to consider the quoted prices and use those prices when you're determining the selling price. moving on to the transfer pricing documentation, you are required, if you are having transactions with associated persons, or as I said, with persons that are in a beneficial tax regime jurisdiction, you are required to prepare and retain your local file and your master file. Your local file will document the transactions, it's entity specific, and will document the transactions entered into by that specific company, whereas your master file needs to document transactions at a group level, including all the transactions entered into by the group. And these regulations for transfer pricing are effective from the 1st of July, indicates that businesses must start complying with these updated rules effective from that date. As I said, companies need to retain the transfer pricing document to substantiate the transfer pricing policies and positions, and ensure that these are readily available for inspection by the Eswatini Revenue Authority. Just moving on to any practical implications. So for companies, you need to ensure that you review annually or adjust any transfer pricing policies to comply with the new regulations. You need to prepare and maintain transfer pricing documentation. As I said, you need to retain both local files and master files in order for you to avoid any penalties and ensure that should you be in a case where there's any audits, your transfer pricing policies can be substantiated and ensuring that your audits are smooth. As I said, it applies to both cross-border and domestic transactions, and you should ensure that you closely monitor these transactions to ensure that they meet the arm's length standard. I just want to conclude, and just in terms of transfer pricing, we have noted that there has been an increase in transfer pricing audits, especially within the African region. So you are urged that to ensure that you evidence your arm's length nature of your transactions with your cross-border and your domestic transactions, as I indicated before. And your transfer pricing documentation, it should not only be technically sound, but it should also be factually accurate and elaborate enough to tell the transfer pricing story to a reader in adequate detail. And you just need to make it simple and make sure that you are evidencing your arm's length pricing, and also you include the functions, assets, and risks, but that's going to get too technical now. But I just want to say, just make it simple and make sure that you document all your domestic and cross-border related party transactions. I don't know if you have anything to conclude on, Russell.
I will have a couple of things. I think just on the transfer pricing, I think this is just a reflection of a trend across the continent again. So countries getting away from a general anti-avoidance rule approach or a broad requirement to use arm's length pricing to very detailed transfer pricing rules. So that's the thing. I see we've got two questions here on transfer pricing, which maybe we could have about 3 questions now. In fact, one is, do the TP documentation requirements apply for transactions after the 1st of July or for years of assessment beginning after 1st of July? I was trying to dig up the copy I've got of the Amendment Act, but have you got a view on that? See very quickly.
Yes, I'm just going to go back to the slide. As I said, the new transfer pricing regulations are effective from the 1st of July, 2024. There was transfer pricing rules, but not as detailed before. You were required to make sure that your transactions between your associated persons are arm's length. That was included before in the legislation. However, now there's more detail that has been inserted to guide taxpayers on on the methods that should be used and the type of documentation that is required. So previously you were required to ensure that your transactions are arm's length. However, now you need to make sure that effective from 1 July, you have your transfer pricing documentation to demonstrate that your transactions are arm's length. I think I saw another question whether you need to submit. When I went through this legislation, I didn't see any specific requirements for submission. However, I am aware that you need to make sure that you retain the transfer pricing documentation should there be a request from the Revenue Authority for the company to submit, or should there be a request for verification or a request for information from the Revenue Authority?
Yeah, I think that's my view as well. I couldn't find anything saying you had to file with the.
Yeah.
I suppose it's always possible they'll some stage change the rules of what you have to put in your tax return, but at the moment not. But you'd have to have it available for when you get the query. And the second is as to when it applies from. Yeah, I think it would be. You've got August 24 year end. Somewhere there's a definition of what a year of assessment is. I think you'd probably require to do it for that particular year. Broadly, if you've got a year which the 25% tax rate will apply to, then I think you'll need to have your transfer pricing in line as well. And as Siegler was saying, that's perhaps not such a bad thing, such a demanding thing, because there was always this rather vague requirement to use the arm's length method anyway. So I tend to think, and again, we can tidy it up later on, and, think about it more, but I tend to think you would have to apply it for the same years as the new reduced rate of tax will apply for, if that makes any sense. So Vanola, I think, perhaps we can have a discussion afterwards when in respect to that particular and precise question. I have a suspicion it'd be the 24 year. Yeah. My overall thinking with this thing is that there's a lot of good things in here, but as with most tax law in most countries, and that includes the UK, sometimes you wonder what were they thinking of, and did they think through all the ramifications of this? And it's difficult on the tax authority or the government side to think about all the possibilities and the things that could go wrong. But I've seen it in my Nigerian experience. It's very easy to forget about things or have unexpected consequences. I think there are some things in this legislative changes that I thought perhaps weren't as well thought through as they perhaps could have been. But again, the Eswatini government's got the opportunity to make changes in later time to try and refine it. And I kind of expected at some stage more detailed practice notes from the ERA. I know they've done some training sessions, and they put out a document which purports to tell you what it all means, and it's pretty high level, but we might expect there's some more. Is there a threshold for transfer pricing in Eswatini? I suspect it's 0, but Siegler?
When I went through the legislation, Russell, there wasn't any requirements for a threshold, whereas in South Africa, there is a threshold of 100 million. However, they just said any transactions entered between associated persons should be at arm's length. I did not see any specific requirements. The only specific requirements were pertaining to the methods that should be used. However, in terms of threshold requirements, there wasn't anything that was highlighted there. Perhaps something to also follow up and include going forward. However, as I said, I didn't see anything.
Yeah, I couldn't see anything either, and I think that means any transaction is theoretically required to be compliant. I would say, and it's often a naive hope, that you'd expect the tax authority to apply its mind and its attention and resources to the more important circumstances, but sometimes that doesn't happen. And so I don't think there's an easy get out. And probably the best thing is to have some sort of defence.
Yeah, I agree with you. Yeah,
that's not the best of answers, but that's probably the best we can manage at the moment. Again, if you've got a transaction for 10 rand, you're not going to spend 1,000 rand putting together your documentation for it. You'd rather say, well, what's the worst that can happen? If they doubled the price, it's still not very much. So that might be the practical response to that. You start with dealing with your more important transactions, or the ones that are the riskier. both in the approach and the amount of money involved.
Yeah, I think when you even read the OECD guidelines, you always have to consider the benefit versus the cost. So the OECD is aware that there are materiality or transactions that are material, and certain transactions do not need to be documented. So one always needs to consider the benefit versus the cost. As you said, if you have a transaction for 10 Rand and you go and you document that, it's just going to be a waste of time because the tax authority won't even look at it. So yeah, that's just my view. Hopefully.
Yeah. Yes, I think it's always very difficult to gauge what a tax authority will do, but it still goes back to it would take an awful lot of effort to shift the needle on a small amount, enough to make it worth their doing, or enough to make you too worried about what happens.
Yeah.
So no hard answer is the answer for that question, but or no easy answer. Right.
Yeah.
Lots of questions on transfer pricing. Haven't seen much on the other things, neither the good nor the bad. So,
or maybe you were just so clear that people don't have questions.
My view on that is it's impossible to be clear because some of the legislation's not clear. And
yeah.
some of the ways it's going to get applied to the facts is not clear. And I suspect people are going to sit and reflect on what this is and what it means. Probably the next time they come to their year end and try and work out what their tax number is and how they're going to fill the tax return in. And that's when you start getting to queries. But you may also have planning issues. I mentioned earlier that July 2024 rebasing is probably an important piece of planning to start putting values in place rather than scurrying around after the facts in later years. That's one. Try and work out what the effect of the interest deduction limitation is. Probably important. How do you avoid getting caught out by the loss carry forward restriction? Probably also important. The one on manufacturing ring fencing is much more nuanced, I think, and they'll take a little more thinking. And to be honest, that's the sort of thing you might expect ERA coming up to attack in later years when they see a circumstance that they may be interested in. Now, I've got a question here. Is there a rollover applicable to CGT? Will you have to pair the assets one by one? There's a number of rollover provisions. So there's one for, I don't think there's one for necessarily a sale and a reinvestment. There's one for involuntary disposals. There is one for, I'm trying to think how I put it. There's a number. I think, let me try and find the law, and then I can reiterate what I can see, which is perhaps not the best way of doing things, but that's what we got. And it's the 7th schedule. If I can locate it. So there are a number of rollover provisions, is what I was saying, and you've got to get within those. 7th schedule to urban enterprise. I'm wrong. So apologies for this. It'll take me a bit of time to track it down. Cost base is there, and special rules for consideration, non-recognition, transfer of business assets between spouses doesn't help us. Involuntary disposal and on death, rollover relief. So you have one if you're doing a share for asset for share exchange. So resident company sells to a transfers an asset to a company which will have more than 50% of, then you've got a rollover. Liquidation, there's one, and involuntary disposals, I mentioned, there's one, and where you've got a reorganization of a company or a group of companies without a significant change in ownership, underlying ownership or control, then you have a rollover. Otherwise, I don't see one. So if I've got an asset and I sell it and I want to reinvest the proceeds, I haven't seen a rollover for that, which is a bit of a deficiency thinking about it, and could impact people's investment decisions. So it does look like if you've got a big gain on it, you may have a problem. Again, I think that's one of the sort of things won't make a big impact immediately because gains from the 1st of July 24 to now shouldn't be very big. But at some stage in the future, it's probably the sort of thing to go and campaign for a refinement in the law. And I think this is one of those things where the more you look at it, the more you find horrible things and things you don't understand and things that perhaps the law's not going to achieve what it was hoping to achieve or is going to have unexpected negative consequences. So my prediction is there'll be more of those discovered. But this business reinvestment rollover, I can't see it. What we will do after this session, and it may take a wee while, is we will edit the video and we will email the video and the slides to all participants. So if you're registered, they will get it. So there's a few questions about that. And I meant to set that out at the start of the session when I was talking about the housekeeping, and I forgot about it. So that's my apologies, but there it is. Up there, you've got our contacts. If you have questions, and we very much hope that we'll be able to help you with further questions, then please reach us at those two addresses there, or you can reach us through the Regan van Rooy website and track us down that way, and we'd be very happy to hear from you. But it's one of those things, relatively small country, very small economy, but quite big changes, and for some people, some companies, probably quite significant changes. But thank you all for joining us. Thank you for listening. Thank you for the questions, for those who came up with questions. And yeah, we hope to have further interaction with you and hope this has been useful.